and we are recording. In just a moment, I'm going to ask everyone to unmute, and we'll just go around and ask people to give a brief intro, brief intro. Oh, thank you, Jennifer. I think you must have done that. And where they're from, and maybe what they're hoping to learn today. But I want to welcome everyone to the first session of a BDCC program that we're calling REGENER8. And the focus is on business transitions. And this session specifically is focused on seller side considerations. In January, in fact, I think it's January 14th, and we'll start getting the word out Monday. There will be another session, the second session of the REGENER8 program, that's going to focus on buyer side considerations. One of the things that we're going to try to do, so this is a way that I'm going to plant a seed, is in a future session yet to be scheduled, we are going to try to bring some buyers that might be potentially vetted with some interested sellers to connect in a way. So maybe think of it as like a reverse pitch competition or something like that, but it's not a competition. It's really, we're just trying to do a little bit of matchmaking and to try to understand how can we help enable business transitions through the variety of folks that are gathered here today. Also, when we go through and try this introductory exercise, if you're a resource provider, please state that and state what organization you're from. So that'd be super helpful as well. So with that, let's do this intro exercise, and then I'll then, when everyone's finished, I will then introduce our first presenter or panelist, which will be Tammy Richards. So I'm going to ask everyone to unmute.
And then RT, would it be best if you ask people by name? Otherwise, everyone will be chiming in. Right?
Yeah, thank you for that. I'm actually changing my view so that I can see people. So the first person that is up is Connie Burton.
Hi, I have Burton Car Wash, own Burton Car Wash on Putney Road. Have had that business has been for 15 years, but my husband and I started out on Canal Street with Burton Car Wash 45 years ago. So and it's time for me to make a transition to doing something different. I have somebody who I want to take over and who also wants to take over. So I've sort of made one step in that direction, but then I would like to come to this session to sort of help figure out how I go about the process of transferring ownership.
Great, wonderful, thank you, Connie. And the next person I see is Robert de Grunier. Robert, I think we met several years ago. I hope you're doing well, and it's good to see you.
Yeah, good to see you, doing well. Yeah, I have a business, Robert de Grunier Associates. I'm a glass artist located in Townsend, and thinking about the transition into the next 5 years, what that would look like. And I am nurturing somebody now at the studio that potentially could take over the business side, not necessarily the real estate side. And just interested to hear people's viewpoints about how one transforms into a future retirement.
Great, thank you, sir. And Ellen Cappy, how are you?
Hi. So I'm Ellen Cappy. I have Mocha Joe's. My husband and I started 30 years ago, and I'd say every 3 or 4 years lately, we contemplate how it might look to maybe transition part of our business. I don't think we're ready to transition the whole business. And, you know, it makes us nervous because it's emotional and we're not sure how that would look. So we're just starting to investigate, I guess I'd say.
Yeah, and you bring up a great point. One of the things that, and Jennifer might touch on this, so I don't want to go too deep into this, but one of our hopes is out of this program, which we're actually calling a pilot, is that it just starts to build awareness, because people need to start thinking about this stuff, you know, probably 3 to 5 years before, you know, the transition actually happens. But we'll get more into that in a bit. All right, the next person on my screen is Marie from VITA.
Hi, I'm Marie Dussault from VITA. I'm a commercial lender at VITA and have worked for many, many years with BDCC on lots of different projects as well, and in the Brattleboro and Greater County area. I'm here as, I guess, a resource. If there's any questions on the role that VITA could play, maybe not so much on the seller side, but definitely maybe on the next session on the buyer side. So
Yep.
we're here to help in any way we can.
Great, thank you, Marie. And it's important for sellers to know that there's a resource, the Vermont Economic Development Authority. It's a financing resource. Yep. Next, I see Ingrid and Franklin from True North Granola.
Hi, good morning. I guess that takes care of it, RT. We're good. We're Ingrid and Franklin, owners of True North Granola.
Great, sorry, thank you.
That's great.
Jeff Sands.
Hi, I'm Jeff Sands from Dorset Partners over in Dorset, and a active buyer of businesses, mostly commercial, industrial, and trying to stay above 5 million in revenues.
Okay, very good. Thank you. Kate and Charles.
Hi, we're Kate and Charles. We're from Putney Mountain Winery. And we've been in business for 22 years now. And we're thinking, one of the things we're thinking about is cooperative ownership and how to create that, or whether to create it, or what it all means.
Great, wonderful. So we've got Don here from the Vermont Employee Ownership Center, and he's going to be, providing us some background. So that's wonderful. Tom Porter.
Thank you, RT. I work with Marie Dussault at the Vermont Economic Development Authority, and we are a resource, again, mostly to people buying businesses or expanding them. And we're happy to be a resource.
Great, thank you so much. Tracy Sloan.
Hi, I'm Tracy Sloan. I'm a CPA in Brattleboro, and it looks like most of my clients are kind of aging out and looking to figure out what to do with their businesses. So this is very timely.
Okay, great. Great. Thank you for joining us. And Michelle Cooper Smith.
Hi, I'm just here with Don Jamison. I work with the EOC.
Wonderful. Thank you. Christopher Chapman.
Hey, I'm with the Trust Company of Vermont, and what I am is a trust administrator, and I help an awful lot of people with retirement planning and estate planning in conjunction with their professional advisors, attorneys, accountants mainly. And I'm very interested in this seminar because of the very important matter of business succession.
Yep.
Our company is not interested in selling. We're owned by ourselves by way of an ESOP. Yep. And so I understand that ESOPs will be part of the presentation today, and which is wonderful. I can't recommend them highly enough, especially small businesses, especially because of the ancillary benefits of sustained presence of the wisdom of the people in the company. Yeah. And So anyway,
Great, thank you.
that's me.
Wonderful
Yeah.
joining. Wonderful of you to join. Okay, Jim Berzino.
Hi, I'm Jim Berzino. I'm owner of Creators Financial. We are a bookkeeping and fractional CFO firm for primarily food and agriculture businesses. And I guess you'd put us in the resource category. We help with putting your financials together, as well as creating procedures and things like that for succession.
Wonderful. Thanks for joining us. And I'm just totally confused, but we've got two Thomas Porters. So the Thomas Porter who has not spoken.
Yeah, hi, sorry, I'm Peter Sampson with Vita, and I was just trying to change my name on there. So I'll do that while.
I can help pack some wholesale orders later, so you save some jewelry.
Can you guys hear me okay?
I can. I don't know if somebody else is talking or.
Yeah, I just heard that as well, so.
Yeah. Well, thank you for joining us.
Oh, sure. So anyway, I'm Vita's chief loan officer, and we're always interested in finding ways to finance change of ownership transactions, and I'm particularly interested because we got to make sure we finance these to keep the ownership in Vermont, as opposed to any opportunities that companies have to sell to strategic buyers or private equity firms. We always want to try to keep the ownership here in Vermont, and anything we can do to help banks finance it is really a goal that we have at Vita.
Great, thank you. John Van Woodkey.
And I have now fixed my name and title.
Nice house, Pete. That yours?
All right, sorry, one of the session participants who registered called me, so I wanted to pick that up. I wasn't able to hear John, so let's keep this going. Let's go to Dennis Smith.
Okay, hi.
All right, let's go to Michelle Doucette.
Hi, I'm Michelle Doucette. I'm a chiropractor and zero balancing practitioner and a teacher of this work in Wilmington. And not really considering transitioning quite yet, but interested in looking into the future. And I don't even know if this applies to me because I'm a one-person company with one full-time employee.
Great. Thank you. I was just sending off that email to that participant who's looking to join. So thank you for tolerating that. All right, so that's wonderful. We have a great cross section of some businesses as well as some resource providers. I think it's important that we have these kinds of discussions and help everyone understand who's here to help and who focuses on what. At this point, I am going to introduce Jennifer Stromston, who is the BDCC's Director of Programs. And Jennifer is going to give us some insights into why it is that we think that programming like this is important, and also, yeah, I mean, so that's basically the crux of it. So Jennifer is sharing her screen, and take it away, please. Oh, you're muted.
My controls. Okay, sorry. When the controls move, I get really confused. Hi, I am that person. I'm Jen Stromston, I'm Director of Programs. I'm just going to give you like a 3-minute like why we worry about this, in addition to caring about the individual businesses that folks like RT work with. So just giving the bird's eye view on this. We, as everyone knows, we are super great at having our more than our share of an aging population. And so those of us over 50, I chose over 60 because that was actually an easy census thing to grab. I wanted over 50, but I didn't have the time to parse that. So I want to just kind of give you this comparison that compared to the nation, we do have a greater share of folks over 60. It's about 30% of our population. And so when you start to look at what that means, what that sort of implies about our business owners, if you just say, well, let's say roughly 30% of that is people over 60, you know, we have probably 562 private companies at risk. And I'll talk to you in a second about why I'm using the term at risk, but we're saying there's, you know, probably well over 500 private companies and over 5,000 jobs that are in the hands of folks who would like to be, or will soon be contemplating retirement, or maybe even past the point of wanting to contemplate retirement. And this doesn't even include sole proprietors or non-employer establishments. So this is really just private employment. This is happening across the country. And so boomer-owned businesses are really a major share of the economy. I'm taking this data from an organization that's really starting to pilot great succession planning stuff across the country. We can't quite afford them yet, but we're gonna work on that. They're doing some things at scale, and they are doing some great research that we've been following closely, ready for next cities. They, one of the things they point to is that not only do boomers or folks over 60 own a large proportion of the businesses, they also tend to own businesses that are of higher value. And so, you know, and that's a result of the expertise and the time they've put into those establishments. So by their estimate, based on, they've done some sample on specific economies looking at the actual data, they're seeing it about 40% of a city's entire economy might be made up of boomer-owned businesses. And sort of then, you know, what happens if they don't make it, right? What happens if you have a transition that doesn't succeed and that business just closes? When we look at Windham County, we often hear stories about, oh, you know, what a shame that X business on Main Street closed, or I can't believe that restaurant isn't going to reopen, especially, you know, with COVID. And that's really important. And I think those are the kind of the businesses that give us joy and that we see that make our towns great. But what's really affected is every sector, right? It's just, this is just across the board. You know, we see obviously in agriculture, we see it in manufacturing, we see it in the trades. And, you know, and to a large extent, one of the things that concerns us, especially as economic developers, is the impact on the kinds of businesses that don't like have to be here, but that bring dollars into the region, that create jobs in the region, but could just as easily evaporate or go somewhere else in a transition. Sort of back to the point that the gentleman from VITA made. So what, you know, what happens when a business is at risk, you know, of just closing, is you end up looking at a situation where you're going to lose that business's spending, its value in the economy, the tax payments it makes, the tax payments to the town, to the state, the owners, their sort of, you know, earnings and spending may go down. That wealth may just be removed from sort of the business economy. It becomes personal wealth potentially, but it's not kind of working in the economy in the way that we would love to see it. Jobs potentially lost. You know, so we think of succession planning as almost like sort of a recycling program. Like, let's get that money back to work, keep it working in the economy. And it's a tremendous opportunity. It is substantially easier from our perspective as economic developers to continue a business than to start a business from scratch. You know, the things that you have all worked to build, that took a lot. and we'd like to start from there rather than having every entrepreneur start from the beginning all the time. It costs a lot more, you know, just in terms of the public investment needed, the time invested, the resources to create a new job than it does to sustain an existing job. National wage stagnation in general makes business ownership pretty appealing. There's some great data on both the sort of better household wealth position of sort of older proprietors versus those who are existing on wages. And there's also some really great data on sort of the additional wealth that creates in Vermont. Windham County has some of the highest levels of additional household wealth generated by business ownership. So that could be as the sole source of income, or it could be like side hustle, like additional income to a household, which is really important because in general, we don't have terrific household incomes. You know, we have relatively low median wages. So the contribution of businesses to, frankly, the well-being of households here is a thing we really keep an eye on. And finally, we know as an agency, and we work with a lot of local partners on trying to attract and retain people, working with young professionals, working with companies to attract people, that there are not always enough jobs or the right jobs for folks to be able to live here, even though a lot of people want to live here. And so entrepreneurship, the ability to start or to acquire or become a partner in a business here is an incredible tool for attraction. So this is a great opportunity, when we have kind of a lot of happy parties. And then my last message to you, is you're in good company. Based on the Ready for Next research, everyone that they have worked with and surveyed so far, only 3 in 10 baby boomers have a plan. So that means it's normal not to have a plan. So great place to start. And thank you for being here for today. This is wherever you are, you're in the right place now.
Awesome. Thank you, Jennifer. Okay, so I think we're gonna jump right into some of the formal presentation or panelist segments here. And to start, Tammy Richards is going to present, and Tammy is with Country Business, which is located here in Brattleboro. Tammy has over 20 years of experience in finance and business valuation. She's worked for Citigroup in New York, and has managed a global loan portfolio of large leverage corporate loans. So not only that, she has worked for an accounting firm doing business valuations, so some of what we'll be talking about today. And she's a certified valuation analyst, which is a designation from a nationally recognized professional association. Tammy's on the board of the Brattleboro Development Credit Corporation, the Vermont Economic Development Authority, and a trustee at the Brattleboro Retreat. So clearly, Tammy has a great depth of experience in the field, and I'm very grateful that she's able to join us today. Tammy, looks like you're unmuted. I am going to share my screen to load the presentation. Going into presenter mode. Thought I was going into.
So this is all new to me. I'm not that tech savvy, so hopefully this will work well.
Hold on one second.
Transfer the screen over.
I'm fighting with my PowerPoint. All right, Tammy, now I'm going to give you control.
Right.
And let me know if that's the right instance.
I think so.
Yep, I just saw my mouse move.
Oh, this is mine. Is your mouse moving?
Yeah, try.
Okay.
Okay.
Not sure if it's switching slides here.
If you put the mouse in the lower left corner, do you see those little advanced buttons?
I'm looking right. I do not see them. No.
Okay, hold on. Let me. Oh. What's
Is that
happening?
me or you? Oh, I think maybe it was a delay. So let's see now.
I think you're doing that.
I think so. Trying to get back to the beginning. No, it might be easier to have you control it.
Okay, I'm happy to.
Yeah, I'll just do next slide or.
Okay, I'll go back to the
Wait, is it working now? I think it's working now.
Oh, okay.
Or it was for a minute. Sorry, this is, like we said, this is our first doing this webinar, so or Zoominar, whatever we call it. Okay, it's not working. I'm just gonna let you control it for ease. So welcome everyone. I appreciate you all coming in. This is, like we said, a new venture for us. Most of the presentations I give are 1 live and 2, probably at least 2 hours in length. So trying to condense this into what I felt was most appropriate for the audience that we have and thinking about what information would be helpful to you to take away from today. So if we start with our first slide. So the first question, what is succession planning? And everyone has in their mind what it means to them. It's not necessarily all about transferring a business. Some of it can be management succession planning and what that means to bring up that next level of management for someone to take over the reins. So that's more talking an internal transition, which is something that Don will speak to later. Then there's, simple ownership succession. And sounds like many people on the call today are looking at potentially leaving their business behind at some point. And one of the key takeaways here is that it's not simply an exit. Succession planning is not about the sale of your business. It's about what leads to the sale of your business or the transition of your business at some point in time. And the whole goal, as RT pointed out too, is this can be a 5-year process for many people. And the earlier you start planning, the better chances you have of selling your business or transitioning your business. It's all about continuing to build the value. We'll talk about the valuation piece as we go forward, and really reducing the risk to both you and to a prospective buyer coming in, or that next level of person coming in to take over your business. So it's really about securing the future of your business and defining what that means to you, because that means different things to different people as well. Next slide, RT. So one thing we'll talk about is everyone on the call here, it's a private business. It's a privately held corporation. There's no open market to go and sell the public shares of your business. So what it really means is converting that equity that you have in that business into something that can help fund you through the remainder of your lifetime, or whatever that next step is. Maybe you're not looking to retire yet. Maybe you're looking to move on from this business to enter into something else, to pursue another interest, another passion that you have. It's really taking somewhat of an illiquid asset and converting that into cash for you to pursue your next endeavor. It's also about transferring not only the ownership, but also making sure that you're doing that without putting unnecessary financial risk to yourself and to a buyer coming in. We'll talk about the appropriate decisions on what the future looks like for you, for the company, for your family. A lot of these are family-owned businesses, and keeping it within the family can be a very important consideration for your business. Now, my husband happens to be a 3rd-generation owner of a business here in Brattleboro, and we don't see that very often. Very rarely do they make it past the 2nd generation, and we're seeing more and more that they're not even making it to that 2nd generation, given the types of businesses, the mindset of today's generation and their work ethic and what they like to do. And it's about balancing not only your personal expectations, but of course, your financial expectations. There's tax consequences, if it's an estate, how you handle that with respect to maybe gifting to family members, or can you raise enough capital through the sale in a tax effective way that it could fund your retirement going forward. RT. So we talked about this a little bit, but why is it important to have a plan in place? Without fail, at some point in time, every business will need to leave their business. Hopefully it's not for death, disability, but more often it's for financial retirement reasons. The top reason that people sell or move on, look to transition their business, is burnout, boredom, fatigue. You've dedicated your entire career and life to building a successful business. And at some point, the motivation starts to tail off. You go in with a large level of excitement, you're looking to grow this. And as we see with most of the sellers we deal with, at some point that drive and determination starts to wane. So, retirement and also financial needs, their business for most small business owners is their largest financial asset. It's not liquid at the moment, but it's probably what they're looking at to fund their retirement, to fund their future. Next slide. This is what I talked about initially when I said if your ownership in your business is illiquid or it's not public, your privately held business is usually your largest asset. It represents the most likely primary source of income going forward. We look at businesses that have both a business and real estate. Oftentimes there's situations where it makes sense to sell a business and keep the real estate and lease that to the new business owner. So that provides for a recurring source of income for some period of time, for the term of that lease. And again, we talked about planning ahead. You know, anyone can say today they want to sell the business next year or 6 months from now. The most typical time frame for selling a business from the start of an engagement until the time it's sold can be anywhere from 12 to 18 months. And that's just from the time you decide you want to sell. You back that up and we'll talk about positioning your business for sale, because there's many things that you need to do and think about as you enter into that phase before you decide to sell. And that again comes to reducing your risk and enhancing the value of that business. Next slide. So speaking about that, I heard someone on the phone earlier say that they're kind of mentoring an employee to take over the business side of their business. And that is extremely important for a lot of businesses, particularly service-oriented businesses, where people are coming to your business for a level of service, and they knowing that, so there's two types of buyers coming in. One is someone who's going to come in and operate your business and take your place and do everything you do. There's someone else who might come in and say, we just want to have an investment. So we want someone else to run it for us. And we want to just look at this as an investment property or an investment business. So the more you can reduce the dependence of your business on you specifically as an owner and transfer that knowledge to your employees, your staff, other management team, the better positioned you are for a new buyer coming in. Any buyer coming in, regardless of what they're looking to do, need those employees and need to know that the knowledge base and the institutional knowledge is going to remain with the business going forward, because that's something they don't have. Also, making sure that you really try to position the business so that the staff and yourself and the person coming in can really just stay focused on the business. The less stress that you can put on the business, the better it is for a buyer coming in. And again, we talked about making sure we have someone that is able to step up to the plate and be that leader in that corporation. Next page. So there's a couple of different things, and I heard someone on the phone say it's going to be difficult to let go. This is a very emotional time for business owners when they have to transition out of a business. I'm working with a business right now where it's a bookstore. And if anyone knows booksellers, they are very, very committed to their business. They love what they do. And it is extremely important for them to see that this business continue the way it has in the past. And they are being extremely selective in the buyers. So we've had a number of people come in looking at this business, but they have turned down a number of buyers simply because they don't feel like they would live up to their expectations. So there's always the financial piece, which is important to most people, but there's a balance. And how do you make that balance work for you? One, being ready to let go of the business, to walk away, that's extremely difficult. If it is a family business where there's other family involved, how do you balance that? If they want to take over, but perhaps you're not willing to let go to them and you want to sell to a third party, how do you manage all those factors? And again, keep in mind, this is a very illiquid asset. So when it's time to market the business, you can't simply pick up the phone and sell some shares of stock. It's a long process going in. There's a lot that needs to be done to prepare the business for sale. So the more information you can gather, the more conversations you can have, the better you are off in selling the business when the time comes. Next slide. So we're going to talk, before we get into the actual sale of a business, which is what I specifically do, we're going to talk about how do we actually go about building a succession plan. And the first is really identifying the goals and objectives. The second is determining value. That's the first thing that we do with any business owner when they come to us, is help them figure out what their business is worth and what we feel we could effectively and successfully market it for. Again, thinking about the different transfer options, I'm only going to discuss the sale to a third party. There are other alternatives we'll just briefly touch upon. And designing, implementing the plan, which we don't have time to get into that specifically, but we'll point out a few of the key things that really define a successful plan. Next page. We talked about this a little bit. I like this pictorial because it really shows that everything has to align. You have business goals, your financial needs, and family goals. You may want to keep the business in the family, but you may not financially be able to do that. If it's a small business that doesn't generate a whole lot of income, and you would love to see your son or daughter run the business, but you also need to sell that business to a third party in order to get the financial income that you need, that's extremely important to you as well. And one of the things that we advise sellers on when they first come to us, we are very good at coming up with a value and what we feel we could successfully sell a business for, but what we don't know is what your financial needs are coming into this or coming out of this business. So we like to work with a team of advisors, someone like a Chris Chapman who introduced himself earlier, someone who you work with on your retirement. They can help you determine what it is you need to realize from the sale of your business to meet those needs going forward and fund you through retirement. You also might have some business goals. It might be extremely important for you to see the business that you've built continue as it has been. You don't want the name change. You don't want them to change the products or the service levels, which, like I said, the bookseller, they're extremely, it's extremely important to them that the business continues as it has in the past. So finding a balance of all of these and identifying what the goals and objectives are is the first thing you would need to do in developing a succession plan. Next slide. I think we've touched upon most of these already. Again, these are just examples of what your goals might be and how you identify and prioritize them. Next slide. So this is another slide I really like. As I mentioned earlier, you come in and you decide you're going to build a business and you create a business. So from day one of that startup, your goal is to create value. Value for your customers, value for your client base, value internally, value for yourself. And throughout your ownership of the business, when you're managing this business, your ultimate goal is to enhance value. And by enhanced value, people might initially think, well, let's grow our revenue, let's grow our bottom line, reduce costs, be effective as we can. And that is one aspect of enhancing value. The other thing, which we'll touch upon later, are the intangible factors. And that really has to do with, your reputation, the level of your products and services, how the outside world views your business. It may not, and value again is in the eyes of the beholder, but what you're really trying to do here is to make sure that someone outside can see this and can see the value in your business. And then finally, the third stage in this life cycle is when you transfer that, what this whole presentation is on, in your succession plan. And that's the time to realize the value that you built up over the years. Next slide. So if we talk about the general market and things of stocks and things like that, everyone knows that it's really a function of your risk and return. If you're willing to take a higher level of risk for a higher level of return, if your expectation is lower in terms of what you expect to receive, it's really a trade-off. And so that doesn't work just in the markets and thinking about what you'll invest in outside, but also thinks about your business too. So the less risk in your business, the higher the return could potentially be. And what drives that? There's the financial performance, which is quantitative. And we can look at that and we can look at numbers and financials and tax returns and really get an understanding of what your business delivers in terms of monetary value. And then there's also qualitative factors. And here I list the strength of management, which is a key one. But there's also other qualitative factors that go into how we value what we call goodwill or the intangible component of your business. And we'll talk about that again as well later. Next slide. So what this really points to, again, is that value is based on the expectation of future returns. Even when we look at financial numbers, a business buyer coming in likes to look at the historical performance as a general sense of what the business has done to indicate, to present to them what it can do in the future. They're not buying the past performance, they're buying the future performance. So while we look at that, what we want to make sure is that as you build a succession plan, that you try to reduce that risk for the buyer coming in. And along those lines, when you have a plan in place, it's also reducing the uncertainty to you of what that profitability might be. If you don't have a succession plan or a business plan in place, things might slide. You may not be as focused on the ultimate goal of selling or transferring your business. And having a plan that you follow really helps control that process. Next slide. So what are the options for transferring your business? One is a third-party sale, which is what I'll talk about a bit more. The other is a transition within family. And we do help and advise business owners do that as well. It's more of a consulting role, and we help negotiate that because, as you might imagine, that could be a very emotional process. One of the roles of a business broker, even in third-party sales, is to be that middleman. I always tell my clients that if we ever got a buyer and a seller in a room together, we would never close a deal. It's helpful to have a third-party, somewhat unbiased position in negotiating that. When I translate information from a seller to a buyer and vice versa, I often have to, what's the word I'm looking for? I don't want to say manipulate, that sounds wrong, but really think about how I present things. Because if I take word for word what a seller has said, it may not go over well with a buyer and vice versa. So it's really about managing that sale. The third part is a management buyout. And then fourth is sales to employees using ESOPs or worker cooperatives. And I believe Don will touch upon both of those. Next slide. Again, we don't have time to go into exactly how to build a complete succession plan, but just things to think about as you go through that process. One, it's great to have a plan. But we always say you plan the work and work the plan because things change over time. You need to make sure you're being able to accommodate for any contingencies or anything that comes up, any changes and different paths you choose as you work through the process. Having a management succession plan in place and thinking about who that leadership might be, even that can change because that management person you had in mind may not be with you 3 years from now. One of the most important pieces is the business valuation, which again is going to change and have to be updated over time. But having a sense of what your business is worth today helps you determine how you go on with your plan. You might decide based on your valuation that you get today that you really can't afford to sell for another 5 years because you need to build up that business. You need to build the value over the next 5 years to be able to transfer it for a price that will meet your needs going forward. We have often worked with sellers that come in and we look at their financials and we have conversations with them and we say, now is not the time. Most business owners will make more money by continuing to run their business than they will by selling it. We'll get into valuation later, but in general, businesses sell for somewhere between two to 3 times discretionary earnings. So if you think of a business that's generating cash flow of say $100,000 and an owner might be taking out close to that because either through profit and their own compensation, that's 2 to 3 years of income. So sorry, so I thought someone was talking there. By working another 2 to 3 years, you can realize that. If you work another 5 years, you've got 5 times that. So once you sell your business, your ongoing income is no longer coming in. So timing is really affected by the value of your business today and what you think you can sell it for and how you can build that up. Next slide. So selling to a third party, there's obviously strengths and weaknesses, and there's pluses and minuses. One of the strengths is that it's a clean exit for the most part. There are some exceptions to that rule, of course, but there's no family involvement. There's no ties to employees. You sell, you walk away, the business is no longer on your plate. There's also potential for a higher return. When I said we work with sellers in family transitions or employee transitions, that is something that we do, we negotiate. And I always like to tell sellers that what we're negotiating for is a fair price. something that's fair to the employee or the family member, and it's fair for the seller. When we're looking to the external market, we're looking for the best possible price. And the only way to know that is to put it out there and have buyers come in, and the market will ultimately dictate what the business is worth or what the value is. There's also investment value. So there are other strategic buyers out there who look at a business, and depending on the industry you're in, depending on the type of business, there are investor businesses, other people in that industry looking to grow their business through entering a new market, through acquisitions. And for them, they can take this business, pull it into their existing organization, reduce overhead, reduce, have more efficiencies, and they can see a greater value in that, because ultimately their bottom line will be higher than what it would be for an individual buyer. Weaknesses, I'll talk about the continuation of business being uncertain. Again, that is a challenge. And you never know what the buyer from the outside is going to do with that business. They might take it and turn around completely. And if that's important to you, then that's something to consider. And the other weakness here, talking about the contingent sale price or use of earnouts, and particularly in this market I'm seeing with COVID, I have a lot of buyers coming in saying, the future is uncertain for a lot of business owners, and there's a lot more risk now because of COVID, and we don't know when the end of COVID is in sight. So because of that, we would like to have an earnout in our structure. And what that means is that they will pay a seller a fixed price at closing and have an earnout based on what we would like to see as top level revenue over a period of 12 months, 18 months. And if your business reaches those earnouts, you can collect an additional sum of money. So what that's doing is putting some of the risk on you as a seller. So that's something that you could also see with internal transfers, but probably more often with third-party sales. Next slide. How am I doing on time, RT? Because I don't have my clock showing, am I? Oh, you're on mute.
Sorry, thanks. I think you're fine.
Okay.
Yeah, keep
Okay.
going.
I'll try to pick things up a little bit. So this is something that I usually put up here, and I like to kind of have a conversation with the attendees, but obviously this format doesn't work for that. But the key here, what I'm trying to get to with all these questions is, we talked about how your business is your most valuable asset. Most of you probably don't know what it's worth today. I think most business owners have an idea in their mind of what they would like it to be worth. And unfortunately, one of the reasons that businesses don't sell is a disconnect in what the market will accept as a value and what business owners see as a value, which is completely understandable, because as a business owner, you've invested your life and time into growing this business, and you would like it to be worth $1 million. And unfortunately, that's not always the case. So being realistic and knowing that. So these are just questions which lead to understanding why you need a succession plan. If you don't know the answers to all of these questions, that's telling you that, yes, you really need to start thinking about things, because it is a long process. Next slide. Again, touched upon a lot of this, really understanding how we convert that illiquid asset to cash and what the value is. And I think we'll get into valuation next. So RT. So I don't want to overwhelm people with all the academic approaches to how we value a business, but I want to lay a few things out. There are 3 conventional approaches to valuing a business. One is looking at the assets. What are the assets of your business worth? And looking at it on both a book value and market value basis. On a book value basis, my guess is most of your businesses would be worth 0 because you've depreciated those assets. Not to say your business isn't worth anything, but from a straight academic perspective, looking at the book value of your assets, they've been depreciated. The book value is 0, but there is an in-place working value to those assets. The second is and what the asset approach does is that would be more applicable to a real estate holding company, something where the underlying asset isn't generating income. The second approach is a market approach, where we're looking at other sales of similar businesses and seeing what they've sold for as a multiple of income. A lot of people have heard of rules of thumb. people generally say for industries, there's certain rules of thumbs on which they'll sell by. I will tell you in general, for small businesses, they will sell somewhere between 2 to 3 times discretionary cash flow. And what I mean by discretionary cash flow is looking at your net income, adding back any non-cash costs like depreciation, amortization, adding back interest expense, and also adding back a seller's discretionary income. And that would be comprised of both their salary, what they're taking as owner's compensation, and also other discretionary costs, which we'll talk about as well. You know, those could be travel expenses, vehicle expenses, any personal non-business expenses that have been expensed through the business for financial reporting. And then finally, we have an income approach, which is looking strictly at your earnings and doing a discounted cash flow analysis or applying a multiple that we've arrived at. What we do as business brokers, and I think makes the most sense for a lot of the businesses we work with, is what we call an excess earning approach, and it combines both the asset or cost approach and an income approach, because every business is worth a combination of its fixed assets, its hard assets, and goodwill. That's how we look at businesses. And the goodwill of these intangible assets, that's really driven by the income stream of your business, or that discretionary cash flow that we talked about. Next page. So just so people understand what I'm talking about when I say fixed assets and the tangible versus intangible, you know, the tangible assets are, you know, real estate, real property, equipment, it could be inventory, and it's pretty easy or straightforward to determine what the value of those assets are. The intangible assets is really the key to business valuation. How do we quantify something that is intangible? Next page. Just some quick examples of what these intangibles are. Customer relationships, contracts, location, technology, employees, all of these things are contributing to your performance as a business owner. So how we value those intangibles is we take that seller discretionary earnings, which we talked about. We assume that your fixed assets have to generate some level of return for your business. Once you determine what that expected return is, we compare that to the actual discretionary income that your business is generating. And any surplus we attribute to these intangible assets. So for example, if your business generates $100,000 in cash flow and your fixed assets based on a 5% return should generate $50,000, we have $50,000 of cash flow that's being generated that is related to all these other intangible factors, your reputation, your service, the contracts or relationships you have, maybe you have a great location. And that's what we need to quantify as goodwill. And to do that, we look at qualitative factors, the strength of your earnings, the industry as a whole, your growth prospects, and we come up with a multiple that we apply to that cash flow. And ultimately, that's how we derive your value. Next slide. Just to kind of go back and how we look at the financial statements, there are a number of things that we do that we call recasting. It's really to normalize our financial statements to adjust it for a new buyer coming in. What a new buyer is looking for is what's the cash flow they can take out of a business. So we want to make sure that it removes all of our any owner-related expenses. If there's surplus or deficit staffing, if we have 5 family members and 2 of them get paid a salary on the books, but don't really contribute to the business, we want to adjust for that. If there are any extraordinary one-time expenses, we want to add those back. We talked about the personal expenses, and those are the types of things we want to look at when we look at your financial statements to be able to assess the true value. Next page. So when we look at that cash, when we get that figure, we feel like there are 4 golden rules. That cash flow needs to be sufficient to, 1, pay the debt that's going to be accrued when a buyer comes in to buy your business. There will be debt service that needs to be met. Needs to pay a reasonable salary for a new owner. And needs to replace assets as necessary. So any maintenance capital that needs to be reinvested each and every year. And it also needs to return some level of return on investment for that buyer. If the cash flow is insufficient to do those four things, the business is not in a position to be sold, at least to an outside third party, because those are the four things that need to be met. Next page. So I put this in because it's easy for me to tell you and say what the rules of thumb are and what things typically sell for, but this is, as you'll see, from 2010 to 2020, what, or at least the fourth, yes, through the fourth quarter. I think it's through the third quarter technically because fourth quarter hasn't been completed, but you'll see this is based on businesses by net sales. So the very bottom line, as you see along there, is for businesses that generate revenue somewhere between $0 and $1 million a year. So they're closer to that 2x multiple I talked about. As you get to larger businesses, which my sense is most people on the phone are probably within that $1 to $5 million revenue range, or within that 0 to 5 million, you see the multiples come up a little bit to that 3x. Anything above that, between 5 and 10 million and over 10 million, we really start getting into the middle market businesses. And they, as the size of the business goes up, you'll see that the selling multiple also goes up. Next slide. So not that I expect you to memorize this by any means, but this is just showing you a little bit on how the multiples vary by industry sector over the period of time. And as you would expect, there are meaningful differences between the different industries. I will tell you that right now, trying to sell a restaurant will be extremely difficult, given the current restrictions and the environment around that in COVID. Restaurants are difficult to sell anyway, but that's one example. The things that always seem to sell well are manufacturing. No, that's okay. Manufacturing, wholesale, retail is somewhat difficult, but again, you can see the multiples here. Next page. Okay, so I'm just going to walk quickly through kind of the sale of a business and how that works. You can go to the next page. So how do you go about selling a business? The first thing is we have to attract prospects, and we have to identify the types of buyers out there. There are a number of different types of buyers. There's this is how our organization works. We have an internal database of buyers that we can reach out to. Do we want to look for similar companies for a specific business and look and directly approach those synergistic buyers? There's also professional equity groups, and they typically look for larger businesses in that middle market range of that $5 to $10 million, and at least $1 million of EBITDA. So we have to decide who we are trying to attract as prospects. The next step we do after, well, first we decide what our value is, and that's by collecting a lot of financial data from you all and coming up with a value. Then we put together a business summary, and I'm happy to share examples of any of these with you guys over time after the call, which is enough of information to go out to buyers to identify the type of business, the price, some limited financial information. Doesn't identify the business because we want to keep that confidential as long as we can. As buyers come in from that prospectus, we then put our detailed prospectus together, and that is really a more thorough presentation of your business, includes detailed financial statements. It goes through the strengths and weaknesses of your businesses, what the growth prospects are, and gives a buyer a really good understanding of your business. In between the business summary and the confidential business report, we would ask any respective buyer to complete a financial data form for us, which lists their financial assets and also serves as a confidentiality agreement. Next page. I think we talked about this is, three primary types of buyers. One, it's a financial buyer. Those are the private equity groups. Strategic buyers would be someone in your industry arena who are looking to expand their organization through acquisition, entering a new market, perhaps a new product line that overlaps with theirs and complements their product line. And then there's the individual or family or couple who are looking to buy a business. Next page. So once we identify what our buyer is, and we even have a buyer in place, now we have to actually structure the deal. And how do we structure a deal? And in a way that is most effective for you. We need to balance your tax needs, any business issues, is there going to be an earn out involved, your personal needs in terms of financials. So we help advise and structure that transaction and the purchase price and an allocation with the help of a number of financial advisors, which will be the next page. Well, we like to put this slide up here because it's not always what you sell a business for, it's what you get to keep. And that has to do with how things are structured for tax purposes. Uncle Sam will always get his portion of your sale proceeds, and working with an accountant and legal advisors, we can work to structure a transaction the most tax advantageous for you. Next page. So we will work with you all the way up until the time we find a buyer. Once we find a buyer, that's the point, and sometimes even before then, where we really have to engage our other advisors, our attorneys, accountants, bankers, to see what is most important to you. How do we structure this from a legal perspective and a tax perspective? That's where our accountants come in. And we really walk you all the way through the closing of a transaction. Next page. I'm not going to talk about this too much, but financing the transaction. So we work primarily with the sell side. That being said, when we identify a buyer, we are extremely helpful and supportive of the buyer in helping them finance a transaction. If they can't finance the transaction, there is no transaction. So we have often helped buyers put together business plans. We introduce them to banks. We help them through that process. The more helpful we can be to them, the more we are helping our clients. But in terms of financing, there are a number of different options. We like to see at least 20% equity coming in from a buyer on a transaction. Typically, banks like to see that as well. So there are other alternatives. There's conventional financing. There's SBA guaranteed financing, which we often see because the SBA was more willing to finance goodwill than a traditional lender would. And as you might suspect, a lot of businesses we work with have a substantial amount of goodwill involved. So as we come up with a value, we go through our what we call an academic process of looking at, we do a market price analysis. Once we arrive at a value, we do two things. One, we make sure it's in alignment with what we've seen in the marketplace and market multiples. And we also test it against a hypothetical buyer. We make assumptions based on our knowledge of the lending markets, on interest rates, on term, on percentages that they're willing to lend on certain assets and different lending classifications. And we make sure that that cash flow is sufficient to support all that and also meet the debt service coverage ratios of at least 1.15, sometimes 1.2. And if we come up with a value that doesn't work for a hypothetical buyer at 20% interest, we will decide that that is not a correct valuation and we need to adjust that. So we come up with a value and test it against a lot of different things to make sure it actually will be accepted in the marketplace. Next slide. Very quickly, I think this is my last slide here. What are market conditions today? At any time, there's always demand for successful, well-priced businesses. And that continues even in today's marketplace of COVID, particularly with people trying to enter this area as being a low COVID risk. We see a lot of that. We see a lot more appetite for businesses. There aren't many mid-market businesses, at least particularly in this area, just because it's where we happen to live. So we don't really work with private equity groups that much. We do on occasion see a large corporation that we work with, but there are not many available. And we get, I'd say, at least 5 emails a day from private equity groups looking for businesses. Interest rates continue to be low and there's high demand with limited supply, which is hopefully going to change with the baby boomer generation coming out. So it really is a seller's market. Baby boomers, we expect that transitions will increase significantly over the next 10 years. Low interest rates have, up until now, I'm not sure where we have to just double check on that now, but with low interest rates, sellers are thinking, for me to sell my business and invest in the market and receive a lower rate of return than it would by owning the business, they're less inclined to do so. And while financial institutions are, people wonder where we're at given the current situation and being overloaded with SBA and PPP and lots of other COVID-related issues, financial institutions are still willing to lend, and they are out there looking to help strong businesses succeed. And I think, was that my last slide? I think so. I tried to get as much as I could in a brief period of time and probably over allotted myself. So Don, I apologize. And I think that's it. And anyone who wants to reach out, I'm not sure, RT, if you're sharing emails at the end of this, but feel free to reach out to me by email or phone if I didn't cover anything specifically you want addressed, and I'm happy to do that.
Yeah, we'll put the website in your email also in the chat. And thank you so much, Tammy. I should have said this up at the top of the session, but if you have any questions, put them in the chat. We are collecting them, and then we'll get to the questions after the panelists' presentations. So I neglected at the top to part of the team here is attorney David Dunn. David, if you just want to say hello. David is here if any questions come up that require a expert legal answer. So hi, David. Sorry about
No
that.
problem.
Okay.
David Dunn. I'm a partner at Phillips Dunn, Shriver and Carroll here in Brattleboro. I do work for the BDCC. Most of my practice is business and real estate oriented. A large part or significant part of it is not just working with existing businesses, but dealing with transitions of all kinds to third-party buyers, representing buyers, sellers, family transitions, and also I have a background in commercial litigation that has me familiar with issues relating to personal liability issues and bankruptcy issues, as well as valuation issues. So I have worked with a number of the people who were on the call, and also with Tammy, and thanks for letting me participate.
Yeah, great. Thank you. Thank you so much, David. Okay, next up, I several weeks ago had a conversation with Mr. William Daly from the Vermont Country Deli. And as we were chatting, I realized it would be great to have Bill provide some perspective, maybe call it a reflective practitioner, because he has gone through the process that Tammy just presented on. So he was a third-party buyer of the Vermont Country Deli, and Bill has a wonderful, diverse background. He's on the board of trustees with the Brattleboro Memorial Hospital, the Brattleboro Walk-In Clinic. He has worked for some high-tech companies, such as Unisys, and there's another one on here that I guess it got cut off. Oracle. I should have forgotten that one. That was the obvious one. But Bill also served as the assistant vice president and controller for Norwich University for some time. But to start things off, he has an accounting background. So, his approach to buying a business is probably a bit more sophisticated than most. That's an assumption from me, so I shouldn't. So I'll put that out there. But I wanted to take a few minutes to have Bill share a little bit about his background and how that sort of led to him looking at acquiring a business. And Tammy laid out a lot of things to think about. Those golden rules, like paying the debt, being able to pay salary, being able to replace assets, and the last one, being able to provide a return on investment. So, and Bill had his own approach and criteria for buying a business, which I thought was really interesting. But also, full disclosure, Bill worked with Country Business and Tammy on the acquisition. So,
and Dave Dunn.
Okay, didn't know that. But so, Bill, if you could just share, a little bit about your background and then your thought process into looking for a business, and then how you settled on Vermont Country Deli. That'd be really great.
Sure. First, thank you for having me. I'm not an expert, but I've just been through the process. I did use Country Business, which they were great help, and I'll get to. I'd like to talk a little bit about using a broker in that. But my background, I am a CPA, or I was a CPA. I worked for Norwich. I was on an investment committee there for the board of trustees there. I was a controller. I did financial statements and a lot of financial analysis there. I implemented computer systems, and then I started working for basically Oracle, and went around to colleges and universities and implemented systems there. And I did that for about 20 years. And at the end of 20 years, being on the road, I wanted to do something else. I always wanted to own my own business. And my wife and I decided at that time that we were going to purchase a business. And I actually looked at a few businesses in North Carolina and Maine and that, and then hooked up with, actually it was Phil Steckler at Country Business. And he sent me to a couple. I actually put some bids in on a number of different businesses, and went through a particular process by which to do that. One of which was finding the businesses, and this is where I want to say that's where having a broker, that's the best thing that they bring to the table. They have a database there that they bring to the table, and they have a list of businesses. They've in the terms of Country Business, they have really done their homework on the business. So they come through and they look at all the analysis that Tammy pretty much went through in the presentation here. And so when they're giving you, they're giving you financial statements and that for the past 5 years of the business, so you can really look at it and see how they're doing. From my perspective, I look at it, and again, as Tammy said, you're looking at it from a cash flow. Is it going to be profitable? How's it going to be profitable over the years? And then I'm looking also for recipes. Is there systems in place? Is there a recipe for the business to be successful? So do they have good systems that you can carry on going forward? So I went through that process, and then you come down, you hone down. Another reason you would use a good reason to use a broker is if they have to deliver bad news. I'd rather have the broker deliver bad news to the seller, or from a buyer to a seller, or for the seller back to the buyer, because the relationship between the buyer and seller, it's really a seller-seller relationship. The seller is trying to say that this is they're a wonderful business, they're how great it is and all this, and the buyer is trying to sell the opposite. They're trying to say, well, it's not so wonderful, it's not, it's not what you're offering. So you're trying to, and that's kind of the process of the negotiation and all that, which using the broker, you want to come out on the other end of this negotiation with the seller on your side and compatible, because you also have to use that owner as a source of knowledge and transition, and you want to have a good basis. And by having the broker deliver bad news or news, etc., that helps. I went through about probably 6 or 7 different businesses, and then Phil came up with the Vermont Country Deli, of which I knew, and we went through due diligence. We went through a number of pieces. The analysis. I spreadsheet everything to the nth degree. So we went through that, and then we went through the negotiation, and then as Tammy said, there's other variations in this too that the seller may have. The seller, in my case, wanted to know that the business was going to be keep going on. Was worried about the workers, them being kept on, and that the business was going to go forward. And then they also wanted to interview my wife. I was buying the business, and they wanted to interview my wife because they wanted to have a female in the business that was going to take it on. So there's very different dichotomies and negotiations in that. Bottom line is, it's a selling relationship, and you're going back and forth with the negotiation. From the context of maybe seller's remorse or the mental aspect of selling a business, you've put a lot of effort, time into your business, and in the process, they're seller's remorse. And from the buyer's side, my thing is, just be patient. You need to work through those pieces and talk through those pieces going forward. In succession planning, I guess Tammy had spoke to that.
Shoot, Bill, you're breaking up a little bit.
Really for being transferred to a member.
Hey, Bill, can you hear me? I don't know if anybody else is.
Two, you can sell it. Go ahead.
Yeah, can you hear me? Is Bill
Yeah, I
breaking
can hear
up
you.
for anybody else? Yes, no?
Yeah, it's not coming clear for me either. It was kind of.
Sorry,
Yeah.
Bill.
Maybe Phil turns off his video.
Sorry.
Might help.
Yeah, turn off your video. That does help sometimes.
There we go.
Yeah, thank you.
Is that better? Okay.
It sounds like so.
Okay.
Maybe rewind just a paragraph.
Basically, there's primarily 4 options that a business owner has for selling a business. One is transfer the business to a family member. And again, there's dynamics there. Is the family member capable of being able to do it? There may be more than one family member, and what are the who wants to own the company, and how is that going to be set up? The second option is sell the company to a key employee or a business partner. So this is where the employee stock ownerships or those types of things can come through. And then who's really qualified and has the qualifications to take over the business. 3 is selling the company, the key employees, that kind of thing. And then 4th is sell the company to an outside purchasers, which is through what Tammy's basically been discussing here. So there's a number of dynamics there. From a buying perspective, I was steered to a book that I would highly recommend. It's called How to Buy a Good Business at a Great Price. And it's I think the guy's name was James Parker. You can look it up on the web, but he goes through through really the process from a buyer perspective of how to purchase a business, and I use that quite extensively. And the bottom line comes down to, from buying it, is what is the business worth to you as the buyer? I mean, the seller can have a price, the seller can have all these other things out there, but what is it worth to you, to buy? And another item when I was buying businesses, what's not perfect yet? How could I make it better? And this leads to how can I make it better? How can I improve the profitability of it and that? So, and
yeah, Bill.
Yeah.
When we spoke, you had a great say. It was something like, when from a buyer perspective, and I think this is important for sellers to hear, you said something like you were looking for a business that you could make great or something like that.
Yes. it's basically the name of the book that I just told you. I'm
Okay.
I'm trying to buy a good business at a great price and make it great.
And make
Okay.
it, okay.
Okay. And so you don't want to buy a great business because there's very limited amounts of things you can do with it. You want to buy, and you don't really want a bad business because nobody really wants to buy a bad business. And you want to buy a good business, something that's that's profitable, something that it's ongoing, and that you can, and then there are opportunities there that you can make it great.
And,
So
and an example of one of those opportunities could be something like, and maybe this was an example from the Vermont Country Deli, like they didn't have any cost accounting in place. They, from the actual recipes, the ingredients that go into a particular food item, going into that, you knew you could make an improvement on that business because you could implement some cost accounting and really get a better understanding of food costs and so forth, correct?
I came in, they had recipes in that, but they didn't have and they were using financial statements just to look at, is my margins in line, that kind of thing. But I came in as a cost accountant and basically broke down the menus down to the individual items that we're serving to find out what the margins are, to see if, what we were doing. In some places I had to beef it up. I also improved the place. They had just a standalone register that was capturing minimal data, and it was taking, I don't know, 3 to 5 minutes for the credit card system to go through, and we had lines out the door that were incredible. So we had to speed up the service and get things to be better. So when I came in, and part of the due diligence, I was taking notes all the way of how can I make the business better, and that weighs into the decisions going to buy the business.
Thank you. So from the seller side, I think there's some value in people being, maybe somewhat self-reflective, so in taking a look at their business, your business, from that perspective. And maybe there's an opportunity there to say, all right, well, if so I'm putting my hat on as a seller. I don't have the energy to put in place the cost accounting, but maybe in your selling proposition, you can articulate to a potential buyer, this is your opportunity to take this business that I'm selling to you from point A to point B.
And
I'm just going to say one thing on that. Oh, sorry, Dave.
I'll go real quickly.
Yeah.
I've had good experience with that from the seller side, where if I have the opportunity to meet with a seller before they've gotten to a letter of intent state, is talk to them about their business and talk to them about the things that they have considered doing but then not implemented yet. For example, one situation where someone had considered but had never gotten around to getting a liquor license for the particular business, and was able to then project by looking at similar businesses what the value would be if they added a liquor license. And then that was an opportunity to say, this is how you can take a good business and make it better.
Yeah, great. Tammy?
I was just going to say that is one of the key things we ask the seller. We have a data form they fill out with lots of qualitative questions. And one is, what would you do if you were buying this business with a new set of eyes and a whole new drive and motivation? And there's a whole section in all of our prospectuses that show here are the opportunities for growth. So as I said, the buyer's buying the future, not the past, and that's extremely important to them. So
yeah. Thank you.
Yeah.
Bill, I know.
I would also add to kind of going down that you're paying for the past, you're considering the present, but you're buying it for the future. Okay. Put it that way.
Distill it.
And you also have to understand that the financials are just part of the equation. That they're the history.
Yep.
Once once you decide to sell the business, that history's there. You can only buy a business because you believe the future will bring will bring you profit, bring you expansion, bring you sustainability, I guess.
Yeah.
In that. So.
Well, Bill, I know you're super busy. Bill was telling us before the session started, he's in the middle of getting things ready up in Mount Snow, and that's been a juggle. So thank you so much for taking the time to chat with us. Bill is a hands-on owner. I've seen him deliver food for different events, putting on the catering event. So we very much appreciate his engagement in that business and in the region. Thank you, Bill.
Thanks.
Okay. Okay. Next up, we have Don Jameson from the Vermont Employee Ownership Center. Don is the founder and the program director, and he helps to plan and deliver VEOC's educational offerings and works with those in established companies to assess the potential of employee ownership for their businesses. It wasn't this year, clearly, because of COVID, but so I think it was the last annual conference that VEOC put on that I attended for the first time, and just for a shameless plug, it's a wonderful event, and if anyone has an opportunity to attend the next one, I would highly recommend it. There's just the presenters that the VEOC is able to gather together are really top notch, and it's a great networking event if you're a service provider, and just a ton of great information that you can get in a condensed period. So thank you, Don, for your work and for that event too. But Don is going to talk to us a bit about ESOPs and employee ownership transfers. Don, you're sharing your slides, is that correct?
I can if you give me presenter powers.
Yeah.
Yeah.
No, I hit the wrong key. I'm going to do that right now. Co-host. All right, you should have the power.
Okay, let's see. Share my screen. Share. There.
All right, it's looking good.
All right. Well, let's see. So yeah, that's me. And what I want to cover, I actually, since Tammy and Bill have talked a lot about some of the issues in selling, the general issues in selling to insiders, I don't want to focus too much on that. And we'll cut to the chase, get to employee ownership a little faster than I thought might be the case. But first, about the organization. We're a 501c3 nonprofit founded almost 20 years ago. It's hard to believe. Based in Burlington, statewide service area. We promote and foster employee ownership for all these good reasons. And I should say that, promoting employee ownership is such a fun thing to do because, as RT said, our conference is lively and there are great companies and really enthusiastic people. And there's definitely a Kool-Aid to be drunk for employee ownership. There's a lot of buzz and excitement at our events. So it's been really fun. We get some funding from sponsors of that conference, especially some fee income, mostly from events, the conference mainly. And we do get an annual grant from the Vermont Agency of Commerce and Community Development, which supports us because they see us as a way of keeping companies locally owned. So employee ownership is not obviously the only way to keep a company locally owned. And I know that you, RT, and Tammy, you work with a lot of people who are looking to buy a local business, and that business is small enough, or for one reason or another, it's going to stay local. So it's certainly not the only way to achieve that end, but it can be a very good way. And the Agency of Commerce sees that. We are pretty lightly staffed. We have one full-time person who is not me, Matt Kropp, our new executive director, who's a whiz and a young star. And Michelle Cooper-Smith and I are part-time. And I want to say a little bit about how we work with people, but I'll save that for the end, after we've talked about, the basics of employee ownership. So, I see employee ownership as part of this larger category of selling a company to inside people. And, there are some kind of general points for doing that. I mean, one is that if you're concerned with preserving the legacy, which is kind of an interesting term, which means different things to different people, but it could be your legacy of service to your customers, or the name of the company, or the culture, the jobs that you support. Probably your best bet is to sell to somebody inside the company. It's also, another motive is to share the risks and rewards of ownership with those who have helped to build the company. That's especially true in sales to key employees or managers or the larger group of employees, but also to family members. And, in a scenario where the seller wants to keep working and exit gradually, selling to an insider is probably the best way to do that too. And then there are some business owners actually that stubborn bookstore owner, Tammy, that you're working with, who is really resistant to some of these outside buyers who are coming forth. They're being very picky about who it is that's going to be. And, some business owners say they don't want to sell to an outsider because the likeliest buyer is their competitor who's been their rival all these years, or they just don't like them, or whatever it is. So either for companies where an outside buyer is not wanted, or probably the bigger category is not likely, just because the company is maybe not super profitable or is in a sector that's not doing terribly well, one reason or another, it's not likely. So for those kinds of owners, they might look to selling to insiders. The challenges are, we've touched on this a bunch of times already today, that the owner's responsibilities in the company have to be shifted over to other people in the company. And, as Bill was saying about looking for good systems, that's part of this shift from the brain of the present owner into systems, but also into capacities of other people in the company. And that makes the company actually, largely more attractive to an outside buyer as well. But it's absolutely necessary for a transfer to an inside buyer. If you, the owner, are the only person who really understands the financials, that's going to have to change. If you're the only one who really represents the company in sales, that's going to have to change. So all that stuff has to be shifted over. Ideally, that happens over a number of years, just as people grow and as the owner wants to take vacations. That's one of the measures that we often use in assessing that the degree to which the owner has transferred things off to other people is, can you go away for a month and things are going to be pretty much okay, or not? And secondly, and I'd actually like to maybe pull in Marie or Tom or Peter from VITA to talk a little bit about this. Financing for sales to insiders can be a little tricky, and it does often include a seller note. That's not necessarily a bad thing, but usually, oftentimes, the key employee you want to sell to, or the larger group of employees, if they're doing it through a cooperative particularly, don't have the resources themselves. So they're going to have to look to outside funders or to the seller note. Sometimes the percentage of down payment is insufficient. So I wonder, Maria, Maria and Tom, are you willing to jump in for a minute and talk a little bit about that?
Sure. Maria, you want to go, or do you want me to?
Well, go ahead.
Sure, we do. You know, it's so each circumstance and business is challenging, and one of the things that it comes to mind in talking about selling, whether it's to an insider or an outsider, but particularly, I guess, to an insider, is looking at, as Tammy said, what amount of goodwill is associated with the purchase price. Because as a lender, it's a lot easier for lenders to make financing decisions and lend toward the hard assets that we can understand and get a better grip on and take collateral on. The goodwill often is associated with things that we can't really finance that much, and so often that tends to be a seller note if the buyers don't have their own resources to put into the business. And it also, having a seller note is also very comforting in a way for us as a lender, because if you have someone who's got an interest in, who's been running the business successfully for some period of time, and they can have an ongoing interest in making sure that it's going to keep going, that's a real benefit.
Yeah, and the lender often likes to see the continued involvement of the seller, so that there's going to be a transition. And if there is a seller note, that person is very interested in making sure that it's going to be a success.
It is important, and it is very helpful, and we like it, but there has to be also a clear kind of management agreement, an understanding of what roles each is going to play, because one of the worst things that can happen is that a successful business is suddenly unsuccessful because now the two people running it are disagreeing, and the new person isn't running it quite the way the old person wants it to be run. And so there has to be a clear delineation of who's doing what and whose roles are what, and how that will wind up.
Tom, if you don't mind my asking a question, do you ask for that in some sort of formal way, that delineation?
Well, we often ask for it whenever there are multiple partners managing a business. We ask, for an operating agreement that defines exactly who's doing what and how. And
very good.
It depends a little bit on the relationship, how formal an agreement you would have
great.
In a sale.
A lot of times that's put into the business. Sorry.
If you don't mind, I'd like to add, well, thanks, Tom, for pointing out, the most difficult challenge with an employee, with any kind of transition, is the intangible asset. Obviously, any seller is going to want to get more for his business than what a bank or a lender like Vita has in mind in terms of what hard traditional collateral is. I'm wondering if in your work, Don, with employee ESOPs, if you've seen the primary owner selling into the ESOP, and obviously the money goes over time to him as you depending on how the ESOP is structured, but sometimes those funds can be used to pledge to the bank.
Yeah.
And it's not a complete breakaway for the seller then, but it can help in filling that gap as well.
Yeah, a lot of times there is a pledge of assets, a pledge of property that's bought with the proceeds of the sale, for example, especially when there's a tax qualified rollover, a capital gains rollover. A lot of times there's a pledge on the assets that are purchased. But we'll get to that because that's really in the weeds of ESOPs. Yeah, but I guess one more kind of general point I wanted to make about selling to an insider is, Bill was talking about the seller versus seller kind of mentality and negotiations between, an outside buyer and the business owner. That's a little trickier with any kind of sale to an insider. If you're negotiating with your family members, well, that can be really tough. In fact, that's the stuff of, tragedy, Greek tragedy, Shakespeare, etc. And with managers also, it can be quite tricky. You've known these people for a certain amount of time, but not as an equal partner. and that can get dicey. So it's the psychology of a sale to the insider is also something that's quite different. We have ways of dealing with some of those problems, but there's no sense in minimizing that. So not going to talk much about this because we've touched on it already. These are not much deeper points. Selling to key employees, just wanted to make the point that, I think Tammy mentioned that sometimes the person that you're working with is the potential buyer internally might leave. That's true. It also can be an attraction to somebody coming in. So if you're saying, well, I'm actually thinking of selling the business, and that might be something that you could move into, that could actually be an incentive for someone coming into a company. And we've talked about this lack of cash down required. We didn't really talk, Tom and Peter, about like, what do you want to say, 20% down payment kind of thing, but well, we can come back to that. I don't want to lose the microphone again. So selling to all the employees. So a lot of times we get calls from people say, I'm interested in employee ownership. I want to sell to one person. Well, that's not what we mean by employee ownership. We talk really about broad-based employee ownership, which is an arrangement where at least everybody who works full-time in the business is going to have a path to being an owner or a partial owner of the company. So it's really for everybody in the company, basically, or at least they're going to have the opportunity. And the most common forms are employee stock ownership plans. That's what ESOP stands for. So employee stock ownership plan, which is a qualified retirement plan. And I'll say that maybe three or four times. That's where the stock in the company is owned by a trust for the benefit of employees. So it's an indirect kind of ownership. It's in some ways, the correct term would be to say that employees are beneficial owners. And they're beneficiaries of the trust. They're not direct owners. We say it's usually for larger scale companies, although I noted that Chris said that ESOPs can work great in smaller companies, and it's true. The rule of thumb for us usually is about 20 employees, and we usually say about $3 million in value, but it depends on how profitable the company is, how much free cash flow there is. So it can work in smaller companies for sure if circumstances are right, and if the company is willing to spend the money that it takes to set one up and to maintain one. The other vehicle that we use actually these days more than the ESOP, just because so many of our companies in the state are small, is the worker cooperative. And in that form, there is direct ownership by employees. It's a little bit, if you were just to kind of sketch what you think of as employee ownership, it probably would sound more like a cooperative than an ESOP. But to start with the ESOP, so the benefits, we've already covered some of these points, but to the selling owner, you're going to get probably a fair market value for your company. And also you're going to achieve potentially some other social goals, like, keeping the company going, keeping it locally owned, keeping the jobs, keeping the name, all those kinds of things. For the employees, the benefit is greater economic security. In an ESOP, that means more in your retirement plan, more engagement at work potentially, especially if managers really use that employee ownership to incentivize people and to get them enthusiastic about making the company more profitable. That can make work much more interesting. For the company, it does improve productivity on average, about 2 to 3%. In participatory companies, 8 to 10%. These according to a bunch of studies that have been done over the years of ESOPs particularly. It decreases absenteeism and turnover rates. And for ESOP, especially S corporation ESOPs, that can lower your taxes a lot. And for the community, which in some ways is the most important thing, it preserves local ownership of the company and the jobs, decreases inequality. That's actually exactly why the ESOP was created back in 1956. So I'll segue to that slide. An employee stock ownership plan, the mechanism was created in 1956. I remember that year because it's the year I was born, by an ingenious attorney named Louis Kelso, who saw the problem, which is much worse now than ever, of there being this big disparity between people who have only wage income and people who have income from wealth. He said, boy, there's got to be a way to help more wage earners have some wealth. And he came up with this idea of this ESOP, which creates a trust to own stock in the company on behalf of employees. So there are now about 7,000 of them in the country and 30 or so in Vermont. And these include some of our best known companies, King Arthur Baking Company and PC Construction, which is the largest ESOP owned company in the state, Gardner Supply Company, Trust Company of Vermont, there, you're on my slide there, Chris. Resource Systems Group, which is a consulting company, Chelsea Green Publishing, VHV and Alliance Group are both each HVAC companies. It's a sector that has a lot of ESOPs in it for some reason. It just caught on there. Switchback Brewing. So you can see a pretty diverse group of companies there, and some of our most prominent best companies that, you know, many of them win the Best Place to Work award every year. So key point again, it's a trust that owns the stock on employees' behalf. The employees don't own directly. The company pays for it, not the employees. So employees are not required to put any skin in the game, but they're getting this retirement benefit, which, if things go well, nets them on average more than twice as much in retirement earnings as for employees in non-ESOP companies. It's funded through pre-tax company contributions, just like with a 401k plan, which is an ESOP is quite comparable to in a lot of ways, but it's funded through these company contributions into a retirement plan, so it's all pre-tax. There is sometimes anxiety about employee ownership, that employees are going to control everything. With an ESOP, employees only get a vote for major company decisions like moving the company, selling the assets of the company, certain major company decisions that are spelled out in law. However, there are some companies that pass through voting rights on any shareholder level decision, and they find that employees tend to be, if anything, rather conservative. There are some significant tax advantages available to the seller through the rollover and capital gains tax, which is available to C corporation sellers, and to the company, especially in S corporations. So advantages of ESOPs, it can be done in stages, and this is actually in some ways, I think the best way to do an ESOP is to do it incrementally. So it's putting less balance sheet stress on the company, not so much debt. Take out a loan, pay it down, take out another loan, pay it down, buy a portion of stock each time. The transition of financial and management control can happen independently. It draws, as we already mentioned, on pre-tax cash flow. There is this potential of capital gains tax deferral for sellers of C corporation stock to an ESOP if they buy qualified replacement property, if they hold that qualified replacement property until it's passed on to their estate, there's a stepped up basis at that point, so they can end up getting out of capital gains tax entirely. With an S corporation, there's no federal tax paid for that portion of the company that's owned by the ESOP. So if the ESOP owns 100% of the company's stock, In an S corporation, you're only taxed at the shareholder level. The ESOP is tax exempt, so no federal taxation paid. That sounds like a tax scam, but remember that the beneficiaries will be paying taxes on that portion of the equity that they realize when they retire. The disadvantages, they are complex. You need some good attorneys, you need valuator, you need a plan administrator who are competent. The attorneys to set up an ESOP are usually pretty expensive. There are bank costs. So we usually say, well, 100 to 150,000 to set up an ESOP. So, it's not for the smaller companies. That's really one of the main reasons, unless there are compelling, there's a lot of profit. The setup costs and the ongoing fees, there is a requirement to have a valuation done every year so that as people leave, they're cashing out of the current value of the company's stock. ESOPs are regulated by both the Federal Department of Labor and the Internal Revenue Service. So, you have to be audit ready. And you do need a suitable employee base. You need to realize enough in tax savings, you need enough people. And it's good if there's a range of ages. The demographic of your employee base is not just like everybody about to retire, because that creates a repurchase obligation that can be disastrous. So it's better if there's a spread of ages. So actually, before I go on to this, I think we have enough time. Chris, could you say a little teeny bit about the ESOP and how it works at the Trust Company of Vermont? You know about this stuff.
Sure, I'd be happy to. I sit on our ESOP committee, and being an employee, I'm really enthusiastic about this because it really does create a central core around which our values orbit. One of the very interesting things that can happen is that the company's earnings can be shared into the ESOP by way of dividends, so that kind of strategy is an excellent incentive for people to stay with the company. The ESOP is is a means of protecting the company against a predatory or potentially predatory relationship with a buyer. The employees can put up some resistance by way of their rights on voting, because they are essentially the owners of everything that's in the ESOP. One thing that I have not heard discussed at all, but which we have found is very, very advantageous, is that when you're looking to cash out of a business, if you've really done the business correctly, keeping employees really well taken care of and involved in the company, their IRAs or what's in their 401ks that could be rolled over to IRAs can purchase stock of the company. And because it's in a tax deferred plan and allowed by the Pension Protection Act of '06, they can transfer what they purchase in their IRAs to the ESOP. Number of people, I'm one of them, did exactly that, so that you can reduce your need for borrowing by giving the employees a chance to participate in the purchase of the company and transfer their interests that they've purchased into the ESOP. Can save a ton of money. Also, your ESOP trustee can be among your employees, and that's very helpful. I'm going to suggest a book, a very small book. I think that the VEOC recommended anyway. It's a wonderful little book, and the title is, and it's for ESOP trustees and the ESOP committee in the company to read. The name of the title is "Don't Do That." And it's a very well written book that provides a great roadmap of things to do and mistakes to avoid, because of the complexity, you can fall into little traps that can become big traps. But when you're advised well, and one of your advisors can be the company that administers the plan that allocates dividends among the participants and shows them their what their accumulated amounts are. It's very similar to the administration of a 401k. You get your statement, it shows what your where your share or where the value of your holdings comes from, what you contributed, what's been contributed in a safe harbor contribution, what earnings have been allocated to you, and so forth. Very, very important. So these outside players, I'm not even talking about banks. I'm talking about the company that conducts your valuation that you have to do every year. That's an expense, but it's a very handy expense if you look at it like that. And also the company that helps you comply with ERISA, the Employee Retirement Income Security Act, that governs pension plans and 401k plans and ESOPs, because those are all qualified plans with the protections of ERISA, and these are major protections. So there's only good that can company, and I'm done. Thank you.
Yeah, I'm just seeing that there's only a few minutes left until noon. I'm sorry about that.
No.
I just
Thanks
checked
for
my
letting me
time.
talk.
I hadn't looked at the time for a minute. So most of the companies, actually the people listening to this are from companies that are too small for an ESOP. So an alternative is the worker cooperative. So worker cooperative is a type of cooperative like a food cooperative, but instead of it's being owned by consumers, it's owned by workers or employees. So membership is limited to those who work in the business. We have about 18 of them now in Vermont, and that number has grown quite a lot over the past 10 years. Construction companies, there are several of them. Red House is a booming company in the Chittenden County area. There's also Green Mountain Spinnery, that's one of the oldest co-ops in the state. It's a manufacturing company. They're famous among knitters. PT360, which is a physical therapy practice. The New School of Montpelier, which is a school for special needs children, which provides services to school districts. So again, quite a diverse group of companies. So with a worker cooperative, each co-op member buys one share and is a direct owner. They get for that share the right to elect a board of directors. If it's a small company, everybody will be on the board of directors, but once you get past about 10 or so, you probably have an elected board. And they also get a share of profits allocated every year, some of it held internally, some of it distributed in cash. Management, I think a lot of people think the cooperative means utterly flat and collective-like. Not necessarily. In fact, the more successful ones, the more long-lasting co-ops tend to have a pretty traditional looking hierarchical structure for operations. They're a lot less expensive to set up and maintain than ESOPs. So it's a good alternative for smaller companies, but it can work in larger companies too. New School of Montpelier, for example, is about 50 people now. And there are worker co-ops with hundreds of employees and member owners. So a good alternative for those smaller companies, but not only for smaller companies. So legal structure can vary. There is a worker cooperative corporation statute in Vermont that some of our co-ops have elected to be set up under. One kind of important concept is that the member share price is not necessarily tied to the value of the company. This is something we'll have to talk about if you're interested in pursuing this at all. This is a kind of a mind bender. But the share price is not tied to company value, but it's rather priced at something that's going to give some serious investment for the employee, but it's going to be accessible to people who are at the lower end of the pay scale through gradual purchase or sometimes financing, outside financing. So with an established company selling to employees via the worker cooperative looks sort of like this. First, you do some exploration. And I would like to assure anybody who's interested in exploring this with us that we do a lot of exploration with the seller usually before introducing the idea to the employees. So there's exploration and some checking of feasibility to see how much debt the company can take on, for example, to assess the management succession issues that there might be, to think about it all, and for the owner to have an adequate opportunity to weigh it against the other options. Then if we're going forward, we talk to employees. They have to like this idea. They actually, ideally, will be involved in writing a business plan for the business, the reborn business, under its cooperative ownership. It's going to show how operations are going to work and how the governance is going to work. And by developing that business plan together, the employees have some business education and they start to work as a group. This can work wonderfully well if there's enough time. Sometimes it happens, actually, part of that education happens after the transaction, so that you pop into the co-op structure and the board starts to function, it has to, and it starts to work. We've had a lot of successes, not many failures with the co-op, because they're vetted pretty carefully before we go forward. So I would encourage any of you small business owners who find this idea at all interesting to please get in touch. We'll walk you down the path as far as you're interested in going. So, yeah, financing, we've talked about a little bit. Equity is usually a fairly small part of the price. So we usually need to go to a co-op friendly lender, like the Cooperative Fund of New England, which knows co-ops, likes to lend to them, and is comfortable with the fact that the employees often are not putting a lot of equity in initially. There often is a seller note involved, but that's true for many sales to insiders. There can be preferred stock as a means of there being outside equity, friendly investors like family members or community members in some cases who love your business. They can own preferred stock to make a deal work. So that's it, and I don't want to go any longer because I see that it's now 12:05, so long enough.
Yeah, Don, thank you. But if folks can hang on for a little bit, I'd like to see if there's any questions. We've been keeping our eye on the chat, so I'm just going to dive into. And if you have to leave, I understand. But we've had a few questions that were submitted prior to the session, and I'm just going to review those. The first one is, beyond the traditional monetary focus on how to sell a business, what other less tangible features of value are considered, and how is their value identified? So we've talked about some of those with related to goodwill and other things. But Tammy, not to put you on the spot, but to put you on the spot, maybe you could just review very quickly some of those other, some of those key intangible features and how a value might be placed on those.
Yeah, sure. So again, there's no magic formulation or calculation that we go about. As I mentioned before, when we look at those intangibles, and there are valuation analysts out there who specifically work on intangible valuation, and there's much more detailed information that goes into that. But from a general sense, we look at the cash flow of the business, and we assume that some of that cash flow is just a return on their fixed assets, on their assets of their business, and anything outside of that is really driven by the intangibles. And we don't classify, we just call it goodwill. We don't specifically attribute that to trademarks or location. We won't get that specific. It's more of a general goodwill valuation. And it really is just, if you look at any value of a business, you take that value and you subtract out the value of the inventory and of the fixed assets, the hard assets in the business, and that's the goodwill factor.
Okay, great. Thank you. The next question I have is, do you have a way to connect with those non-Vermonters who are moving to our state due to the pandemic who might be interested in purchasing a turnkey small business? It's a great question. And that's something we've been thinking about here at the BDCC, especially in light of this program. I see Jennifer biting her lip and ready to jump in.
We are, like, by the skin of our teeth, I think going to be in a position to do a little bit of digital marketing. We have some funding to do that prior to the buyers event. So, and we're working with a, company that actually knows what they're doing around, Google SEO terms and using Facebook better and stuff. So we're going to try leading up to that January event. And then afterwards, I mean, this, as RT said, this is a program that continues. So these events are part of it. But yeah, we're trying to move into that realm.
Yeah, and Tammy, are you seeing that at Country Business? Are you seeing people?
We definitely are.
Yeah.
Yeah, I wouldn't say that we have a specific outreach to target those types of buyers. The way that we market is we send our listings to our in-house buyer database, which many of them have come in on prior listings and haven't found quite the right opportunity yet. And then we also list all our businesses on the two BizQuest and BizBuySell, which are the primary business brokerage websites. So most of the information we're getting or the interest we're getting from those types of buyers are coming in through those websites. Anyone looking for a business to buy, unless it's some big strategic acquirer, are accessing those sites on a regular basis.
Okay.
So that's how we attract those.
And they are BizBuySell, and what was the other one?
BizQuest.
BizQuest. Okay, great. Thank you. Right, the third question I have, what are the various options for selling a business? Obvious outright cash is an option, but what are the other considerations that a business owner might have? I think we've covered that, the third-party buyer, employee ownership, ESOP. What's the fourth? There were four.
I wasn't sure if they were thinking more in terms of purchase price and how that gets financed, or how that gets, what the proceeds are. I mean, if that was the intent of their question, I think we talked about, potential earnouts as one option, seller financing is another option. If it's not all cash at closing, it can be in the form of a consulting agreement, or some kind of compensation going forward. So there's other ways to structure so it's not all cash at closing, if that was the intent of the question.
Yeah, as a follow-up to this session, as I was hearing people chat, I thought maybe a financing session, maybe just an hour or something like that, and getting some of the partners on, like Vita and other folks that just specifically talked about financing and exploring some of the scenarios around that thing.
RT, could I add a couple of real brief comments?
Yeah.
I think from the seller's standpoint, when you're thinking about selling a business, there are a couple things that I would keep primary in your consideration. First, understanding what factors go into increasing the value of your business or detracting from the value of your business. Often, as Tammy has said, if your books and records and financials are nice and tight, that helps it, makes it a lot easier to sell. If they aren't in good shape, then it becomes more problematic. I find that a number of small businesses that are financially successful, the owners are spending time on the business, but not time on the financial records. So that's something that if you're thinking about selling, you can do that over time and get that in good shape. The other thing is that any professional that you work with, whether it's an accountant, a broker, an attorney, involved with a possible sale, make sure you can, to the extent possible, have them understand your business and have them understand the life decisions that you're making in selling your business. Because every one of those professionals is going to, the more you tell them, the more they can structure and tweak whatever transaction is coming down the line and understand how it works for you. That goes to, what is your income needs going forward? What are you trying to protect the existing employees? So those are two things that, I would make sure you keep in mind when you're thinking about selling.
David, thank you. Thank you so much. I think the last question I have is how does a small business show a capacity for growth to a potential new buyer other than through actual sales numbers? And I think, David, I think you touched on this a little bit ago when we were talking about what are those key opportunities that might be missing in the business right now that the seller, understands.
Yeah, and one of the things that Tammy said, the reasons why you sell, one of the reasons is you've done this for so long, and it not necessarily boredom, but you're realizing that maybe new energy would do that. And so if you can self-reflect and say, these are the additional business opportunities that I have decided not to push, whether it's expansion to another location, whether it's adding another product line, if you can think of those, then, and if you discuss those with a broker or any other professional you're working with, they can help you monetize that and present that to in the whole idea of presenting to a potential purchaser.
Fantastic. So I've worked through the questions that we received prior to the session. Are there any questions? And I would recommend that you just open up your mic. I think you have the ability to unmute and ask a question. I understand that, sometimes this could be sensitive. So if you're uncomfortable asking a very pointed question, I'm happy to serve as a mediator, someone in the middle. Can't get the word out. Or I put in the chat the various contact information of our panelists, so you could reach out directly. But if there's anyone that wants to ask a question right here now, please feel free to do so. We have a quiet group.
RT, are you going, what you've written in the chat with all the contact information, are you going to send that in an email follow-up as well? I'm just wondering if people know how to access chat, because it took me a little bit to figure out how to get to that.
Yeah. So I'm going to send a follow-up email. I'm looking at, I'm watching Jennifer type into a Google document as I say this.
Right.
So we're gonna have a couple things in there. We're gonna have the link to the session recording, and we're gonna have a link to a form that we really would like people to complete. Our funder is the USDA, and we have to provide a decent amount of reporting to our funders so they understand what the impact of what we do is. And anybody that was on in this session as a resource provider, we'll include that information as well.
Thank you.
Well, I don't see any other questions or hands up. I want to thank Tammy Richards, Bill Daly, Don Jameson, David Dunn for participating in today's session, the first session of the REGENER8 program. Again, the next session will be on January 14th, which is focused on buyer side considerations. Of course, you're welcome to attend. It might be interesting to hear that perspective as well. If you have any questions, please feel free to email me or anyone that was, of course, here. But thank you for joining. And I hope everyone has a wonderful rest of your day.
Thank you, RT.
Thank you.
Take care.
Thank you.
Thank you very much. Appreciate it.
Thank you. That was great.